Diamondback Energy, 4.2 billion in quarterly revenue, 8 cents in GAAP EPS. That gap is not an accident. The income statement is telling you one thing. The cash generation is telling you something completely different.
EBITDA of $1.4 billion on $4.2 billion in revenue. That is a 33% EBITDA margin from a Permian Basin producer running at full scale after the Endeavor acquisition.
Revenue came in at $4.24 billion, up 5.2% year over year. GAAP EPS was 8 cents, essentially break even on the income statement. Operating margin was less than 1%, but EBITDA was $1.41 billion, a 33% margin. Free cash flow was $895 million, 21% of revenue.
I want to push back on using GAAP EPS to evaluate Diamondback. After completing the $26 billion Endeavor acquisition in 2025, Diamondback carries a massive depreciation and amortization load from the combined asset base. That D&A runs through the income statement every quarter and compresses GAAP net income to near zero. The actual cash generation, what comes out as free cash flow after reinvestment, is nearly $900 million. These are not comparable metrics.
So GAAP EPS is 8 cents because of accounting for a massive acquisition. The cash machine is running at full speed. Lana, walk me through the Diamondback revenue story.
Diamondback is almost entirely Permian Basin, oil and gas production from the Midland and Delaware subbasins in West Texas. Revenue is a direct function of two variables: production volumes in barrels of oil equivalent per day and the realized price on WTI crude and natural gas. The 5.2% year-over-year revenue growth reflects higher production from the Endeavor integration running at full capacity, partially offset by the commodity price environment.
The Endeavor acquisition was the big move. How does it look a full year in?
The Endeavor close added roughly double the acreage and production scale. What you see in Q1 is the combined entity operating at its natural run rate, roughly $4 billion in quarterly revenue, $1,400 million in EBITDA. The integration cost discipline has been strong. Diamondback reduced break-even costs post-close, meaning the marginal production from Endeavor acreage is highly accretive at current oil prices.
The FCF, $895 million in one quarter.
At $4 billion in quarterly revenue with 33% EBITDA and disciplined CapEx, Diamondback generates real free cash flow that flows to capital returns. The company has a dual capital return program, base dividend plus variable dividend or buybacks depending on the price environment. When WTI is above $65, Diamondback is a cash return machine. This quarter demonstrated that the combined entity runs efficiently at scale.
What is the break-even WTI for this business?
Diamondback targets a WTI break-even around $50 to $55 for sustaining production and maintaining the base dividend. At current WTI levels, the entire gap above break-even becomes discretionary cash, returned to shareholders or applied to debt reduction. That low break-even model is the structural advantage of Permian scale relative to higher-cost basins.
The number that reframes this entire quarter, $1.4 billion in EBITDA from a company reporting 8 cents GAAP EPS.
The divergence between GAAP earnings and EBITDA is the structural feature of oil and gas accounting post-acquisition. When Diamondback paid $26 billion for Endeavor, the acquired assets were marked to market value on the balance sheet. That fair value basis gets depreciated over the useful life of the assets, creating a D&A charge every quarter that has nothing to do with current cash performance. Investors who evaluate FANG on GAAP EPS are using the wrong metric.
So Endeavor actually created a structural accounting headwind to GAAP profits, even though the acquisition is working.
Exactly. The acquisition increased revenue, production, and free cash flow meaningfully. But the accounting creates a D&A load that runs through operating income for the next decade. The cash generation is exceptional. The GAAP headline is misleading. Understanding this distinction is the entire thesis on Diamondback. If you anchor to EPS, you will consistently misread the business.
And they are not alone. This is a pattern across major E&P companies that have made large acquisitions.
Every major E&P acquisition in the last 5 years creates this dynamic. ExxonMobil with Pioneer, Occidental with Crown Rock, Diamondback with Endeavor. The GAAP income statement is encumbered with acquisition accounting for years afterward. The industry metric that matters is EBITDA, free cash flow per barrel, and break-even WTI. Those numbers tell you whether the business is actually working.
How does Diamondback compare to the Permian peer group?
Devon Energy and EOG Resources are the closest comparables in scale and Permian exposure. Devon is down 7.4% revenue year over year, reflecting lower realizations and a different production mix. EOG is down 1.6%. Diamondback, growing 5% in that environment, reflects the production growth from the Endeavor integration outpacing the commodity headwind.
The growth premium for FANG, is it the Permian quality or the acquisition scale?
Both. Diamondback has among the best acreage in the Midland Basin, low break-even, high oil cut, multi-decade inventory. The Endeavor acquisition doubled that position without moving up the cost curve. Competitors trying to match that production growth either pay for lower quality acreage or operate in higher cost basins. That cost advantage compounds over time as commodity prices fluctuate.
The valuation, how does FANG price relative to the group?
Diamondback trades at roughly 2.5 times trailing revenue, a slight premium to Devon and ConocoPhillips, but in line with EOG, which also carries a quality premium in the Permian. The argument for the premium is the acreage quality, capital discipline, and low break-even structure. The risk is that oil price compression below $70 forces a rethink on the capital return program, which is where the valuation premium comes from.
What is operationally working for Diamondback?
3 things. The Endeavor integration is delivering production at the volumes promised during deal announcement. The acreage is high quality and the break-even is intact. EBITDA margins at 33% demonstrate the Permian scale advantage over smaller or higher cost operators. And the capital return program is functioning as designed. At current WTI, there is meaningful discretionary cash flowing to shareholders.
Where is Diamondback exposed?
Oil price is the primary risk, full stop. Diamondback's revenue, EBITDA, and free cash flow are directly tied to WTI. If oil falls below $60, the capital return program contracts. Below $55, they are in sustaining-only mode. The business model is excellent, but it cannot escape the commodity cycle. That leverage is both the opportunity and the risk.
And the debt load from the Endeavor acquisition is still significant.
Diamondback carried meaningful debt from the acquisition close. At current cash generation rates, the debt reduction timeline is manageable. The company has guided to reducing leverage to target levels within 2 to 3 years at current oil prices. But if oil weakens significantly, the deleveraging timeline extends and shareholder returns compress. That sequence, lower oil, slower deleveraging, reduced buybacks, multiple compression, is the risk scenario worth watching.
We opened with the gap. 8 cents gap, 1.4 billion EBITDA. Those are not contradictions. They are the same business viewed through 2 different lenses. That is the Diamondback bottom line.
Watch WTI oil prices and Q2 production volumes from the Permian. WTI above $70 is where the capital return thesis works. Production growth sustaining above 500,000 BOE per day validates the Endeavor integration thesis. For full coverage this week, STRL, DuoL, PINs, and more, subscribe to Charged Alpha.
We will see you on the next one. This episode is for informational and educational purposes only and does not constitute financial advice.
Charged Alpha is not a registered investment advisor. Nothing in this episode should be construed as a recommendation to buy or sell any security. Always conduct your own research and consult a qualified financial professional before making any investment decisions.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.